How unsustainable is US government debt? Hi, everyone, and welcome to another episode of Insights brought to you by Ainsley Bullion and the Gold and Silver Standard. Today, we welcome back Alex, who's once again been looking into the specifics of a US government debt situation that's really spiraling out of control and potentially putting the entire global financial system at risk. So, how are you going today, Alex?
I'm going well. How are you?
Against the backdrop of all the chaos that's going on in the world, always good to
Bitcoin
see
going
you.
up, gold going up,
It, it,
DXY going down.
It is. I've been very excited with my Bitcoin trades today. So I'll move away from Bitcoin for a little bit just to talk about this model that you really brought up in the news today. And I do actually think the two are related. But let's start off with really what that was that you were discussing, because it was an interesting model. Interesting being the operative word there. So can you maybe just give us a bit of background around that model and what that is that you were talking about?
So the Penn-Wharton budget model is used to look at the sustainability of government debt and government, I guess, fiscal policy, really. And it's what I found really interesting was I found this model, and it is that number 2050 keeps coming up, that the US won't default at current rates to 2050. And that actually comes from this model. So everyone's using this model to say US is fine. But then I don't really think anyone's read what the model's actually saying, which is what I find really interesting. So 2050 came up, we've now got a US deficit of over 33 trillion. So for starters, the model talks about how only 26 trillion of that is private debt. So forget what the Fed's bought, doesn't matter, doesn't come into it. So what the model says is that you need to go to 200% of GDP, debt to GDP for the model, for default to basically happen, for the US government to default. So at 26 trillion, which isn't 33 trillion, they're saying that we've got to 2050, but read the details and you read some of the assumptions and you look at their historic modeling and they know they're wrong. And they write about they know they're wrong. So, what was interesting, and I hopefully it can be pulled up, but there's a graph from the news today which looks at so the Penn-Wharton model has been used since 2007, and they look at they do a 10-year model. So in 2007, they were estimating that by 2017, debt to GDP would be at 20%. Then you look at 2030, and at that time it was around 75%. When that 10-year period finished, they were about 50% wrong. So in 2013, they estimated right now, 2023, the US would be at 75%. Now, you know that we're at about 125%. So again, they got it wrong by another 50%. And so now let's look at what 2023 says. 2023 says that by 2033, we'll be at 125%. So just going on sheer history and what they've gotten wrong year on year, that's 175%. Now, that's a lot closer to the 200 that they say we've got another 20 years after that to hit. They know it's going to be hit earlier. And there's some pretty big assumptions they're making to go 2050.
See, I mean, we have to laugh a little bit because you would argue a lot of these models can't predict what's going to happen at the end of 2023, let alone what's going to happen by 2050. But
there you go.
You've got these predictions there, and given how far off they are from what you've said, surely we can't be relying on data that is or predictions that are that far off already. So I suppose there's two parts to this question. So can we, obviously we can't rely on it, but can we rely on it maybe a little bit in terms of direction, or is there anything we can pull from that? And also, how do they get this far off? Like, what are they doing? What assumptions are they making that are so wrong that allow them to be this far off in the model that they're using?
So around 2013. So if you look at their modeling from 2007 to 2013, they were always expecting debt to come off. So that say it was 20%, they were expecting 15, or 50, they were expecting 45. And then around 2013, they went, you know what, it's just up. So I think from here we can reliably expect direction is up. Yep. And they are and reliably, that's what it looks like. So what's interesting though is, people are buying bonds with 2050 in mind, that we've got plenty of room to go, so risk is not an issue. But if we only have 10 years to go and you're buying 30-year bonds believing that 2050 is a year, you're not pricing a proper risk premium in.
Yes.
And that really needs to be thought about. Like, reliably, from what I can say, 2030 to 2035 is a more reliable, at this point in time, 200% GDP number. And it doesn't take much to change that. So the assumptions that they're relying on for 2050, which are farcical at this point in time, to say the least, is one comment from the paper says the US is neither at war nor in a recession. So that's not looking like that assumption's going to hold right now. They're assuming no quantitative tightening or quantitative easing. Now, you know that the Fed is selling off their debt, I think at about $1 trillion a year. Is that right? That they're trying to sell the debt off by?
Well, the issue that I have with that is that there's a sell-off, but there's also, it's like one hand passing to the other at the moment, because you've also got these other programs that are effectively buying it back. So
anyway, but this is purely looking at that, because as they quantitative tighten right now, they're selling bonds down, and that has to be bought by the public. Now, it's the public owning the debt, which is the escalation in GDP. It doesn't matter what the Fed holds. So just by quantitative tightening, their assumptions are wrong. So that's the second thing. The third thing is they assume some surpluses, which, considering we're in 2023 and we have not had a surplus in 22 years, that also seems like a fairly presumptuous assumption. And then the third thing is there's no run for the door on bonds. So there's no risk premium priced in, which currently on the 2050 modeling makes sense. But when you actually look at what's going on, 2030, 2035, there should be risk premiums in there, and they're not there yet. So there are 4 assumptions that they've made in the model that are all right now either false or going to be false in the next 6 months.
It's quite concerning, because I take your point too, that a lot of people are relying on these models, or whether they're not aware that they're relying on them, they certainly, that's a lot of the analysis we see. That's a lot of people and experts talking about what we can expect. I think it's really interesting to look at this idea of how the yield curve comes into this as well, because right now we're at a really pointy part in the cycle, right? Like, we've got those yields really pushing up. I think most of them were touching or bumping slightly over 5%. It's getting to the point where the interest on the debt becomes a major problem that needs to be addressed. So if we factor in what we're thinking about the yield curve here, it is quite relevant to all of that you've just discussed, because we've got the issues around that debt being really, the models don't make any sense. People are relying on those models, however, whether they explicitly are relying on them or sort of implicitly relying on the idea that we've got time to run in making their decisions. But you look at where we are right now, and those yields are really spiking up. Most of them have sort of breached, at the different durations, have breached above 5%. So we have a real issue here that it could sort of spiral out of control faster than expected, even faster than that 50% miss in the models. It seems like we're heading into a real a dangerous situation, because you can't rely on the modeling. You've already identified that, but you probably can't even rely on the rate of it always being wrong by 50% on that modeling anymore. Like, it could be much worse than that, right?
Well, I mean, it appears to be spiraling, and so much so that the IMF has recently come out and said that the US debt is the most worrying country in the world for a debt, well, basically a debt spiral, where their debt is just getting out of hand. So, 100%, this has become so far from what the models predicted, and so aggressive in rate rises, quantitative tightening. What if the Fed does drop rates? Well, inflation spikes then, and then there's almost no win from this point in time, and ultimately, you and I've spoken about this a lot, where without risk premium in there, this only gets worse, where the Fed either lets the rates run up, so risk is priced in, and then you've got the US literally debt spiraling at that point because they're paying more. But then if the Fed is to react and they do drop rates while that's going on, well, then you've got inflation out of hand. So it's becoming a no-win situation. And, you know, the gold buying by the central banks around the world, this Bitcoin ETF where you had the BlackRock CEO saying, what was it, a run to, what was the word he used? Not safety.
I don't remember what he used. But I know the sentiment around what he's saying is, you know, this is, we're coming in to play this game because we need alternatives.
Yeah, so everyone is looking at alternatives because, as the IMF said, it is worrying. And it is worrying that this is the reserve currency of the world and it is out of control.
Absolutely. And I mean, we're seeing that play through right now. Today we've seen the Bitcoin price as one example really take off quite substantially. And gold has been right up there pushing to sort of break through to, well, in Australian dollars, it's sort of there in terms of all-time highs, but in US dollars too, it's pushing up towards that. So, you know, the markets are telling you something, and that's against the backdrop of risk really coming off in the share market. So you've had the S&P coming under pressure, you've had the Aussie share market coming under pressure. There's a story being told there that I don't think everyone is listening to, but it's a pretty important story.
Yeah, so the normal reaction, as you know, is flight to USD, flight to bonds. And there's too many bonds. There's probably been a huge flight there, but there's too much now. It's flooded the market. And the US dollar, the DXY, looks incredibly toppy right now. Bank of America just came out and spoke about how the USD long position worldwide is crowded, which usually indicates that there's going to be a turn. So, you know, it all looks like this risk to safety that used to happen is starting to break down. And Bitcoin, it was a flight to quality, not safety, that the BlackRock CEO said. So a flight to quality. And gold, which has always been, you know, has been used previously as a monetary standard, which some of the China, Russia, all the BRICS are really starting to turn to.
Well, as always, we'll keep an eye on this as it unfolds. But each week that we talk about it, we come back and the moves seem to be even more volatile and even pushing us even into greater extremes. So it's certainly a time to be paying attention.
Yeah, it seems like now, you know, yesterday trending was Black Monday. Today trending is Black Tuesday. Everyone thinks that this is very close to breaking. And usually when people think something, it is either going to happen or they make it happen.
Yep. Yeah, that's a fair point to end up on. So thank you for that today, Alex. Always appreciate your insights on this.
Good fun as usual, but this one might not be as fun this week.
Yeah, hopefully you're not fully right, or unless we're all in Bitcoin, in that case, you know, keep it coming. But Bitcoin and gold to the moon.
You know anyone who's just in crypto?
Present company excluded. No, but no, we always have a bit of a mixture. But Bitcoin and gold for me are certainly the way to play this, and that's how I play it personally. I know you're probably a little bit more diversified than me.
Not quite. Just currencies are interesting at the moment.
Yeah, you have your fingers in a lot of pies. So, well, thank you very much. Thanks, Alex. Thanks, everyone, for watching. Remember, if you have any questions, reach out on those social platforms. If you've got any comments you'd like to make, we always read those and appreciate those. That's us for today. We'll be back tomorrow with Brenko to discuss all things markets and metals. Until then, have a great rest of the day, everyone.